Good morning, YouTube fam. As a long-term buy and hold dividend investor, I wanted to cover what a dividend actually is. I was browsing through my library and I noticed I don't have a dividends basics video and thought that would be awesome to go over what dividends are for those new investors out there. So let's dive in. Okay, so what is a dividend? Well, let's take it straight from Investopedia. Investopedia defines a dividend as a distribution of a portion of the company's earnings or profit. These distributions are decided and managed by the company's board of directors and paid to shareholders. So that's simple, right? Common shareholders of dividend-paying companies are typically eligible as long as they own the stock by the dividend date or the cutoff date. That's basically how I look at it. The ex-dividend date is the cutoff date. You don't own it before then, you don't get that quarterly dividend. You have to wait till next quarter. Dividends may be paid out as cash or in the form of additional stock. Or there might be a special dividend like Microsoft paid back in the day. I think they gave like a special dividend of like $3 a share. Can you imagine if you weren't even expecting it and next thing you know, there you go, there's an extra $3 in your pocket. Anyways, larger, more established companies with more predictable profits are often the best dividend payers. These companies tend to issue regular dividends because they seek to maximize shareholder wealth in ways aside from normal growth. Companies in the following industry sectors are observed to be maintaining a regular record of dividend payments. Those are basic materials, oil and gas, banks and financials, healthcare and pharmaceuticals, and utilities. Okay, so what impact do dividends have on a share price? Well, since dividends are irreversible, their payments lead to money going out of the company's books and accounts of the business forever. Therefore, dividend payments impact share prices. It rises on the announcement approximately by the amount of the dividend declared and then declines by a similar amount at the opening session of the ex-dividend date. For example, a company that is trading at $60 per share declares a $2 dividend on the announcement date. As soon as the news becomes public, the share price will shoot up by around $2, and so it'll bump it up to $62. Say the stock trades at $63 one day prior to the ex-dividend date. So on the ex-dividend date, it will come down by a similar $2 and will begin trading at $61 at the start of the trading session on the ex-dividend date. Because anyone buying on the ex-dividend date will not receive the dividend. So why would a company want to pay dividends? Let's talk about that next. So why would a company want to pay dividends? They aren't forced to pay their profits out to the public, with the exception of certain types of dividend payers, for example, REITs. So why do they? Some of the largest companies in the world don't pay dividends. Amazon, Google, Facebook. But what makes them different? I'll tell you what. Age. Immature companies are in the growth stage, and some are very fast growing. The three I mentioned are at least. So they want to reinvest their profits to continue their meteoric growth. Mature, well-established companies, for example, Johnson & Johnson, Chevron, and others, are basically finished growing and aren't taking in enough profits to keep shareholders happy. So one of the main objectives of the board of directors is to keep you, the shareholder, me, happy and confident in the business. They pay dividends from their profits to reward their shareholders for providing them the capital to run the business. There are many reasons dividend payers are better off on the long run than non-dividend payers. There's plenty of data to prove it, but there are also reasonable explanations why. A company that pays a dividend or has a strong dividend history, such as Johnson & Johnson's 58-year dividend paying history, has a certain discipline imposed on them, which makes it seem like they are less likely to waste the money on power-grabbing projects or acquisition or buybacks they've overpaid for. This in turn will attract more investors like you and me. More investors, more money, better stock value. Another reason dividend pairs outperform non-dividend pairs is pretty obvious. You can't fake cash. While companies must adhere to guidelines set forth by the Generally Accepted Accounting Practices, or GAAP, there are a lot of estimates and assumptions in accounting. With each instance of estimation and assumption comes an opportunity for companies to manipulate their income statement to make profits appear higher or lower than they actually are. Looking at you, Luckin Coffee. But cash in you, the investor's account, is hard to manipulate. Dividends keep mature companies honest, and increasing dividends build investor confidence. Okay, so we've gone over what a dividend is. Let's take a look at my portfolio just to kind of keep things spicy. So let's go ahead and open up my Robinhood account. And it looks like I'm up to 75.66 right now. So, all right. We're looking pretty good here. Up 13, 168 for the week, 85 for the month, 908 for the past 3 months, and all time we're up 264. So not too bad. Not too bad. All right. Chubb, Aflac's down. Johnson & Johnson, AbbVie, Pfizer, all those pharmaceuticals are doing well. Leggett, Coke, 45, 38. I was going to buy that with some dividend money today. Might hold off. Let's see. Morgan, JP Morgan's up. O, FRT, WP Carey, they're all in the green. So it looks like it's, I don't want to say it's bullish or bearish right now. It's more like a kangaroo. It's kind of up and down. But here's let me look at the total stock market. We're up 157. Not bad. Alrighty. So there you guys have it. Thank you so much for watching. And I hope you enjoyed today's episode on dividends, what dividends are. If you have any questions, leave them in the comments below. And again, I'll see you next week. Thanks again. May all your investing be a success.